Okay.
All right, good morning, everyone. Welcome to First Team Wednesday trainings. We thank you for being part of First Team Real Estate. We're welcome to have 1031 exchange information that's presented to you from Sell Tax Free here with Justin. And Justin, he's here. You can see him in the conference room. He's got his video on, and you're ready to go. This is being recorded.
Okay, awesome. Thank you for the introduction, Greg. Yeah, and thanks for being here, everybody. I'm sure I've met some of you guys before. David, our CEO, and I did a lot of trainings for First Team kind of pre-pandemic. We did a lot of the office, we'd come into a lot of the offices and do the live seminars there. And then when you guys, I acquired some brokerage down here in San Diego County, we were doing a lot of stuff locally here to us too. But for anyone who doesn't know me, my name's Justin. I'm the lead 1031 exchange consultant here at selltaxfree.com and 1031 Exchange Advantage. So I'll put on some slides in just a second. I'll kind of take you guys through the 1031 exchange and all the kind of basics that I think are really important to know as a real estate professional and how this can help you with your clients. So let me present this here in just a second. All right, everybody see that okay?
Yes, we're good.
Okay, awesome. So you'll see here on the left, David's our CEO. He's not here today. Sometimes he does these with me. I didn't edit the slide or anything, but that's me on the bottom, an old picture of me. But I'm, like I said, I'm the director of business development here and the lead 1031 exchange consultant. So my job every day really is to consult with real estate investors about the properties they're considering selling and the properties they're considering purchasing as part of a 1031 exchange and try to help them optimize their tax bill and how we can see how we can help them save. In California, usually save a pretty good chunk of money. So the first thing that we'll be, or really everything I want you to get out of today really is to show you how the 1031 exchange can help you guys get both sell side leads and buy side leads as a part of any exchange that you spot and that a client is doing. How help you get repeat.
I think it's dumb because it's going to take away from him.
Hold on, Justin, sorry about that.
No worries.
They're not, they're unmuting themselves too as well, so.
No worries.
Got it.
And then the last part here, which I think is most important, 1031 and knowing about this tax break is really just an awesome opportunity for a real estate agent to make themselves look awesome to their clients. Again, usually the amount of money involved, like tax savings wise, is pretty substantial. So if you guys are the ones spotting that opportunity for clients, obviously that can make you guys look great. So first and foremost, the 1031 exchange, it's a tax break from the IRS. It allows you to save money on capital gains taxes and defer paying those capital gains taxes or really ultimately avoid paying them at all. Basically, the exchange has some pretty basic reinvestment requirements and a timeline around it that I'll speak to. But in essence, the IRS is basically just saying you currently own a piece of investment real estate, and we want to see that you purchase a new piece of investment real estate of same or greater value within this timeline that I'll go through in a second. And if you do that, we will not charge you any of the capital gains taxes that would typically be associated with your sale. So as an example here, if you had a client who sold a property for, I know these numbers are not really reflective of current market. I probably should have doubled or tripled everything. But the principles are still the same. If you have a client who sells something for $450,000 and they have $200,000 in equity coming out of the sale after they pay off their existing loan balance, after they pay you guys, brokerage commissions, title and escrow costs. Let's say there's $200,000 in cash left over. The two main requirements of the exchange are for them to reinvest the $200,000 in cash into a new property or multiple properties. that in total are worth at least the same $450,000 value as the property that they sold. So, you know, the IRS basically just wants to see you keeping all your chips on the table with regard to the investment property that you own. And if you do that, you don't have to pay, again, any of the capital gains taxes that would typically be associated with the sale. The timeline around the exchange, aside from the reinvestment requirements up here, the timeline is the other most important part of 1031. So I always like to, I reiterate this like 5 times on every call I have with a client. You have to get exchange documents set up before a sale actually closes escrow. That is absolutely critical. I get a lot of phone calls. It's unfortunate, but you know, across the course of the year, a lot of phone calls where, you know, I closed 2-3 weeks ago, or let alone a few months ago, and it's too late to do the exchange at that point. So it's really critical to note that the exchange documents have to be set up while you are in escrow. That's exactly what we do. We're a 1031 exchange accommodator, qualified intermediary. It all means the same thing. It's our job to document the clients are doing an exchange properly. And it's also our job to hold on to the money from their sale until it is reinvested into the new property that they're buying. So while the documents do have to be set up before closing, the exchange effectively begins on the closing date of the sale. That can be thought of as day 0. So that's when both this 45-day clock and the 180-day clock both start ticking, is on the closing date of the sale. So the client has 45 days from closing to identify to us which new properties they're planning on reinvesting in. We give them a list, like in their exchange agreement that they set up with us, where they can list up to 3 properties of any value. And basically that list is due back to us by day 45. In total, again, starting on the closing date of the sale, they have 180 days to actually complete the purchase of any of the properties that they identified on that form. But I always pause there and just make sure I'm clear. They have to buy something that you know was identified within that 45-day period. They can't change their mind after that. It doesn't matter how hot the market is. It doesn't matter if all the properties, you know, they went and got inspections on them and they came back bad and the client wants to back out. The IRS doesn't care. It's a pretty hard and fast rule for them that they're, you know, pretty strict on. They expect you to have all that kind of stuff done before the 45th day comes around, and for that list to be final by the time that comes around. So I always point out to real estate agents when I, you know, teach this kind of stuff, it's an ideal scenario for you guys to be in as an agent. If you have a client who sells a piece of property for, I mean, you can multiply this by, say it's $1 million property, right? And you have $1 million sale and they want to reinvest. Oftentimes they want to reinvest somewhere in California, and it's certainly not always, but you know, if you have a client who has to go buy, know what they're going to buy within the following 45 days, it's like a slam dunk deal for you.
I'm in over 35.
You know, because you can.
So she said, all right.
Okay.
But I
buy on this strict timeline. So to show you kind of how big the tax bill is, I just always put this here. California property, as you guys know, goes up in value all the time. In particular, right now is the highest prices we've like ever seen. So when a piece of real estate is sold, though, taxes can typically take anywhere between 30 to 40% of the real estate profit as a California resident. I always get the question from clients about how we get to this 30 to 40% number. That is comprised of, well, most clients, I should say, just think that we're just referring to the federal capital gains taxes, which are typically 15% or 20%, depending on how much profit is there and how much your annual income is. While that is part of this number, the state of California, in addition to that federal number, does charge 13.3% at the state level. So if you're in that 20% zone, which a lot of clients are, at the federal level, you add on that California 13.3%, and right there you're at 33.3%. There are a couple other little taxes that I won't go into here, but that are charged as part of real estate profit. And so as a California resident, clients are looking at typically anywhere between 30 and 40% of the profit. If you have clients who've owned property for a really long time, it's definitely closer to the 40% than it is the 30. So just for sake of example, I just made a couple here. Let's say they had $200,000 in profit, right, on the sale of their house. They would typically be looking at a tax bill of $60,000 to $80,000 as California residents. So a big chunk of money. This one's probably a little bit more realistic, just where current values are. You have a client with $350,000 in profit. They're looking at $105,000 to $140,000 in taxes when they sell this piece of real estate. Now, we get clients again all the time. I deal with folks who, the guy who bought in Redondo Beach in 1975, and paid $80,000 for his house, and now it's selling for 1.5 or whatever. That's $1.5 million in profit. So you can do the math, multiply this by a couple times. The numbers can get really, really substantial for California clients who have real estate that's appreciated a lot. So luckily, there are solutions for this. I wanted to talk briefly about the primary residence tax break. It's not something that our company deals with every day, but you guys, I'm sure, deal with this all the time. So I just wanted to touch on it briefly, and it is obviously tax law related. So I wanted to make sure you were aware of the primary residence tax break, in addition to the 1031 exchange, which I'll jump back to on the next slide. But if you have a client selling a primary residence, the way that the IRS kind of describes your ability to use this tax break is if you have lived in the property for 2 of the last 5 years prior to the sale. So I made these kind of bubbles here to show the 5 years prior to the sale. It could be any 2 of these. If you were using the property as a primary residence in any of these 2 out of the last 5 years, you qualify for a tax break if you're single of $250,000. You basically get to take that profit off the table without paying tax on it. If you're married, that number doubles. If you and your spouse have been living in the property 2 of the last 5 years, you get $500,000 of profit tax-free. Interestingly enough, as an aside, I have heard that the federal government is reviewing these numbers and considering increasing their amounts. This law was created, I think, in 1990, somewhere in the 1990s. And so to keep up with inflation and everything, these numbers today really should be a lot larger than they are. They have not changed yet, but hopefully that's coming soon. But yeah, just wanted to make sure you guys were clear on this too, because I'm sure you're dealing with clients who are selling primary residences frequently. But if a client is selling anything but a primary residence, like a property that's used as a rental, a commercial piece of property, really anything aside from a primary residence, that's where the 1031 exchange tax break comes into play. And we went through it a little bit on the previous screen. Clients selling and purchasing new property, that's how the tax break works. The clients save obviously a ton of money. You guys look amazing for having brought this whole thing up to them. And again, because the client is required under the tax code in order to get the benefit of the tax break to buy new property, knowing about this can help you get sell side leads as you talk to sellers in your pipeline. As an example, I was in the airport last week coming back from San Jose. My girlfriend lives up there, her family's up in Northern California. And I just happened to, someone asked me in the airport what I did for a living, making conversation. The lady tells me she inherited 2 commercial buildings, 8 units and 8 apartment units and a commercial building, 1 or 2 other ones I forget, and owns a property down here in San Diego in Carmel Valley that has gone up a ton in value while they've owned it. So being able to speak to 1031 and just kind of know generally, you don't have to know the specifics, but just generally knowing it's out there really can help you get these sell side leads. But again, because everyone requires a reinvestment, 1031 obviously can help you get buy side leads from those same exact clients as well. The issue a lot of the time, and again, from the example I just gave, a lot of time agents and their clients, primarily their clients, but really don't know all the residential property types that can qualify for 1031. It's kind of typically associated with commercial property historically, but there are tons of residential property types that can qualify for this as well. That's what we'll go through here. So so on the left side of the screen, you'll see some of the ones. These are probably the more obvious ones to anyone who is familiar with 1031. The clean cut investment property, like a single family rental, a multifamily rental, property that's used for Airbnb and VRBO. Those are subject to usage requirements. They do want to, you can't rent it for 1 day a year and qualify for 1031. Just want to point that out, but generally speaking, those can qualify as well. Vacant property also qualifies. That the IRS considers a bad investment, but they do still consider it investment property, generally speaking. And then, the most classical use of 1031 is on just straight commercial real estate. So all those ones on the left are kind of the obvious ones. The ones on the right are a little less known, I find. So if you have a client who has a second home or a vacation home, again, those are subject to the usage requirements, much like the Airbnb and VRBO rentals are. But if you have a client with a second home or vacation home, those can qualify for 1031. They don't want to see that you're using it, 6 months of the year. They would want to see your usage limited to much less, and really it's less than 2 weeks per year in the year prior to you selling the property. But not to get too complicated, generally speaking, those can qualify for 1031. Before I speak to these two, again, there are certain scenarios where a primary residence could be subject to, you could use 1031 on it, but just to be totally clear, again, primary residences, generally speaking, or 1031 is not applicable on the sale of a primary residence for the most part. If you have a client with who has a home office or a workspace, or who has been renting out half of the property, let's say they live in a duplex or a triplex or something, at that point, the property can qualify for both tax breaks. In the home office workspace example, I actually had a first team agent, funny enough, who sold her California, I forget where it was, somewhere coastal California, with her husband. They had over the $500,000 of gain on the property, of profit. So their primary residence tax break that we spoke about earlier was not gonna shelter them from their total tax bill. And so they inquired with us about using the home office and workspace. I think it constituted maybe 10% of the total square footage of the property. And therefore 10% of the property was subject to 1061. And they were able to use the exchange on that to shelter additional taxes above that $500,000 primary residence tax break. So it wasn't a crazy amount of money that they were able to save, but it was still, somewhere between $20,000 and $40,000. So still pretty substantial. The final one here, if a property's been involved in a divorce and one party has moved out, the party that has moved out, they still have an interest in this former property. And so when that's sold, potentially they can exchange that too. We had a guy do that in Malibu not that long ago for a property he moved out of a couple of years prior. But again, not to be confusing, generally speaking, 1031 is for everything aside from primary residences. When you exchange, because you're selling and buying, you can also, the exchange is typically associated with the language of like kind exchange. That does not mean that if you buy if you sell a single family rental, you have to buy another single family rental. If you sell a commercial property, you have to buy a commercial property. That is not what it means. Like kind really just means investment for investment. So you can sell any of the property types on the screen here, generally speaking, and buy any of the property types on the screen here as the replacement property. And aside from those, the primary residence examples, again, can get a little funky, but pretty much everything else here would work perfectly fine. So you can sell a single family rental, buy a second home or vacation home as your replacement, and vice versa. You can sell an Airbnb or VRBO rental property that you have and get into a long-term single family rental. You can sell a commercial property and get into a second home or vacation home and vice versa. So all these different combinations work. Again, what we find is that clients really have no idea that this is a possibility for them. Even the clients who are selling commercial property, really, no matter which property type they have, they're often ignorant to a lot of these facts. So just back to an example, like from the first kind of slide we went through, just going through the actual reinvestment requirements and timeline of an example exchange. And I put different trees we did in the background here just to show you do not have to exchange within the same geographic area, really. 1031 is a federal law. And so you can exchange into and out of any property in the United States. Even foreign investors, if you deal with foreign investor clients, if the property is in the United States, they can reinvest anywhere in the United States and have that qualify as 1031 replacement property. So as an example here, if they sold for $450,000 and they had $200,000 in cash equity coming out of the sale after they paid off the loan balance, the brokerage commissions, title and escrow costs, everything like that, they would be required to reinvest the full $200,000 into a new piece of property or multiple pieces of property that in total are worth at least $450,000, same value as the property that they sold. And if they do that, they don't have to pay any of the taxes on the sale. They are able to buy less if they want to. They just, you end up paying some taxes rather than avoiding them all. So if they're looking to avoid them all, these are the requirements they have to meet. Again, same timeline we went through before. Super critical, the exchange needs to be set up while the property is in escrow. So after the offer is accepted, but before the sale actually closes, they have to get their exchange documents set up with us. The sale closing can be thought of as day zero. And again, as we went through before, a client has 45 days only to identify what those replacement properties are going to be. They have to end up buying something that is identified on that list within the 45 days. But in total, again, from the closing date of the sale, they do have 180 days to actually complete the purchase of any of the properties that were identified on this form. And again, if you guys, you're spotting buy-side leads inherently by spotting 1031 opportunities on the sales side for your clients because they are required to reinvest. Just as another example here, same property they're selling, we have it a lot of times where clients don't want to reinvest into another rental property. You deal with somebody who's 70 years old, they're tired of dealing with tenants and toilets and trash and everything that comes along with owning a rental property, but they still would like to take advantage of the benefits that 1031 can provide them. In that instance, there are certain professionally managed properties. I won't go into the specifics of those, but basically you can buy fractional shares in professionally managed commercial real estate. It's a lot like owning like a REIT. If you guys are familiar with those, a real estate investment trust, it is not the same thing. REITs generally do not qualify for 1031. I'm just saying these investments that do qualify structurally are really similar to how a REIT operates. You have a big real estate company that manages everything for you and just sends you a check at the end of every month. But there are certain types of these that can qualify for 1031 reinvestment. So that can be another great thing to point out to clients. It's kind of have your cake and eat it too. If they don't want to reinvest, you can show them how they can reinvest into something that they don't have to manage anymore and still get the tax savings. Again, same timeline still applies. I won't go through it again here, but 45 days and 180 days to complete the purchase. So agents and their clients in the past were expected to remember all this stuff. I'll skip through this. No one remembers all the rules of 1031. The only reason I do is because I work in it every day. We do have a disclosure form that is available for you guys that just kind of is a checklist of a lot of these different property uses that you can use to spot these tax saving opportunities for your clients. I forget the name of your guys' internal like document management system, but I know we had it in there a while ago. I can touch base with Lynn after the call and see if.
Bye, guys. That's everybody.
But just as an example here, we have a couple questions we lay out on the left side. If a client answers yes to any of these, it's probably a good idea for them to have a conversation with us or with their CPA. We do these all the time, but you don't have to use us. But regardless, it's a great opportunity for you guys to spot an opportunity for the client to save money. So as an example, has your property or any portion of it ever been used as a rental? Is your property considered commercial real estate, like multifamily, office, land? You know, has it been used for Airbnb, VRBO, second home, vacation home, all that stuff that we went through on previous screens? If they answer yes to any of them, it's probably a good idea to have a conversation with us and or their CPA to look into the different tax saving opportunities that could be available to them. We do also have these co-branded landing pages available for first team agents. We have a ton of agents who've created these already and used these over the years. But anyway, they use them a lot in CMAs, at listing appointments. There's a do I qualify button on there that is essentially like a digital version of that disclosure form I showed you on the previous screen. The client answers a couple basic questions about the property they're selling. Like their primary residence, is it a primary residence? Is it a former residence, a rental property, etc. Answers a couple more questions and we'll tell them whether or not they qualify for an exchange, and they can schedule a consultation with us right there. If they do this from your actual landing page that you set up, you are notified anytime a client signs up to do that with you here. So again, a lot of agents will use this in CMAs and listing appointments. Sometimes in their marketing efforts, some of them will link to it from their individual website. And again, even if the client ends up, you know, going through this whole qualifying process, let's say it was a primary residence that they were selling, and it doesn't qualify for 1031. A bad 1031 lead is still an awesome listing lead. It's just another way to get a client interested in speaking with you about the sale of their property. And again, from the airport example I gave for myself from this past weekend, that happens to me all the time. So, you know, being able to bring this up and having a place to point clients is a great way to get leads on properties that the clients are thinking of listing. We have agents who use these consultations that we offer in a variety of different ways. Feel free, if you want to offer them to past clients or your sphere. We're happy to consult with clients way ahead of them actually listing their property for sale. We end up touching on things that are really essential for their qualification for 1031 and to help them ensure that their exchange will go smoothly, making sure that title is held in a way that's advantageous for them in doing the exchange, learning their options for the future, and exciting them to list. Again, this is like, you know, if they have a property they're tired of managing, but they want to reposition the equity into something new. You know, we can get them excited to get rid of their problem and take advantage of the tax savings. If you have a listing lead that's gone cold, and it's the type of property that you know, that we listed on the previous screen that would qualify for 1031, a great way to showcase your knowledge, show the clients that you care, that you're looking out for them and for, you know, for their bottom line. Again, exciting them to list. We're happy to do consultations with them to see if we can get them off the mark by highlighting the tax savings. And then if they don't want to reinvest, you know, again, these 1031 they're all buy side leads for you guys. So to the extent a client doesn't want to reinvest, that's another thing we consult with them on all the time. Do they understand their tax bill and their options? You know, we kind of help them get through that and point out those different options that are available to them. So just kind of completing the circle here, You spot these opportunities. The example from the beginning, they had 200,000 in profit, a tax bill of $60,000 to $80,000. You spotted the exchange opportunity and saved them all of this money, which makes you guys look awesome. We had one other example here. If the client had $350,000 in profit, looking at a tax bill of well over $100,000. Again, spotting this opportunity can save them that money. Really makes you guys look great, and kind of big reason for celebration. So we're here to help you. I'll start taking questions here at the end. We have these disclosure forms with the questions. We have the landing pages you guys can create, and I'll show you the web page to do that in just a minute here. But really, we are here to help you and your clients. Again, I want you to just remember 1031 can help you get sell side leads and buy side leads, repeat and referral business, and really make you guys look awesome from spotting such a high value, money saving opportunity for your clients. The web address to go to create a landing page, we have scripts and videos and some other stuff there, FAQs that agents ask us frequently. It would be selltaxfree.com/first-team-agent. And you can, I'll share the presentation and everything after this if you're curious about that URL. That is the place to go. And this, I know, is an old version of First Team's website. I did not get a chance to update this before the presentation today, but I'm pretty sure we are still listed under the services on the homepage of your site. If you guys ever need to know how to get in touch with us, you can be brought to the the First Team kind of corporate page. If you need a quick place to be able to point clients, you are able to schedule a consultation with us directly from there. But that's basically it. We do these webinars fairly frequently. If you guys have any interest in doing them for an individual office that you're a part of, more than happy to do these. We love working with First Team agents. And yeah, this is my contact information. This is just the office number. And then this is my personal email here, justin@selltaxfree.com. I know it says 1031 David on my little Zoom square here, but I'm in the conference room. This is me. Justin at selltaxfree.com. And I think that's it. So I can open it up to questions now. I'm going to open the chat. Greg, I don't know if you want to help administer any of this. Yeah. If you want to read that to me, maybe that's the best way to go. I don't know.
Yeah, we'll start with what the chat was in order, and then we'll open up to voicing questions. Says do the 2 years when it comes to for the exemption. I know that not with the 1031, but just a rather regular exemption, whether you're single or married, do they have to be continuous years? One person asked, or can they be spread out within those 5 years?
They can be spread out. They do not have to be contiguous. Yeah. So what she's referencing, just to be clear for everyone, this is with regards to that primary residence tax break, the 250,000 of tax-free profit if you're single, the 500,000 of tax-free profit if you're married. Yeah, you just have to have lived in the property 2 of the last 5 years to qualify. Those 2 years do not have to be contiguous.
Okay. Next is the current policy that can give you all the 500,000 anymore. So the current policy can't give you the 500,000 anymore, right? If you live there for 2 years out of the 5 years, you can only get 200,000 out of the 500,000 tax-free, right?
No. My understanding, yeah. If you live there 2 of the last 5, if you're a married couple, you get the 500,000. If you're a single person, you get 250,000 of tax.
Okay.
Can I add a little bit to that question? Because that's my question.
Sure.
Go ahead.
Okay, so basically, a buyer was asking me this question. So I kind of asked one of my tax friends who does tax, and she does not specialize in that. But she went ahead and did some digging with her other people. And then that's what she get back to me. She said, 2-year rent should be enough to show your initial investment purpose. Total 5-year ownership can qualify for your Section 121 exclusion game, but amount of exclusion will be prorated between the principal resident period and the rental period. So you will not get 100% out of 500K. And she said that this is a new tax code. It used to be that you qualify for capital gain exclusion if you use the house 2 out of 5 years as a primary residence before selling, but this is that they used to be. So I don't know what the current one is. Still, you can get 100% of the price.
Yeah, that's not my understanding, and I deal with client CPAs pretty frequently, and there are plenty of situations I touch on where the client's using Section 121 on one of their sales, which is the primary residence exclusion, or they're trying to combine it with 1031. Any CPA that I've interacted with has told us that it's just if you live there 2 of the last 5 years, you get the full benefit of depending on if you're single or married. You get the full benefit of that. So,
Okay, got it. But I have another question. What if you're like you own the property more than 5 years and you only have the 2 out of 7 years? For example, you're as a primary residence, can you still get a full benefit of a 500 tax deductible for a couple?
it comes down to the 5 years prior to the sale. Yeah, that's the only time frame.
Oh, okay, got it.
Okay. Next, and then we'll go to the raised hands after this. But if you inherit, aren't the tax laws different? And do you get a stepped up basis?
Great question. Yes, is the answer. Yes. So typically, generally speaking, when a piece of property is inherited, the basis is stepped up. Now, all that means is, let's say a client had bought a property for $100,000 and now it's selling for $1 million. Or they could sell it for $1 million, and that client dies, and their heirs then inherit that property. The heirs inherit the property at that new $1 million value. They are not subject to all the taxes that would be due on that, the $900,000 that the property had gone up in value during the life cycle of ownership. The person who inherits the property receives the property at that new stepped up value, stepped up tax basis. So if they got it, they inherited it yesterday and they sell it today, there's no profit there really for them. So there's no need for them to do an exchange or to use the Section 121, anything like that. They just get to take all that profit tax-free, generally speaking. Where they do start to need to use it again is if they, let's say they inherited the property in 2017 and they're selling it now, the value has gone up a lot from what the value was in 2017 that they inherited it at. So that's where they can still use it. But yes, you are correct. Typically, they do get a stepped up basis when it's inherited.
Okay, and so next one is, can you talk about 1031 exchange with buying more than 3 properties? Are those laws still the same?
I can, yeah. I did not go into it. I didn't want to get overly complicated, but you are correct. Yeah. So if you buy or really when you identify the properties to us, this question is with regards to that 45-day identification requirement. When you identify the properties to us, typically the IRS limits that amount to 3 properties. And if you keep it to 3 properties or under, there's no restriction as to the overall value of property you're identifying. You could identify $100 million of real estate, and that's totally fine. Excuse me, when you get above that 3 property number, so let's say you're identifying 4 or 5 properties, then you are subject to different rules that start to limit the overall value of the property that you're identifying. So as an example, let's say I sold a property for $1 million, and let's say I identify 4 or 5 properties, right? So anything above 3. The total value of the 4 or 5 that I identify cannot exceed 200% or double the same thing, the value of the property that I sold. So again, if I sold for $1 million and I identify 4 or 5 properties, the total value of those 4 or 5 cannot exceed $2 million. So I don't know why the IRS has that rule and tries to limit that. I think they just want to restrict people from identifying the entire available MLS. They want to make people, be really serious about what it is they want to reinvest in. But there's one additional identification rule after that, but I won't even go into it just because it so rarely actually comes up. Those are the main 2 to be aware of: the 3 property rule and the 200% rule.
Okay, and then they hit the same in the same question after that. They mentioned about other exchanges like the 1033, etc. Yeah,
so 1033, I hope I'm thinking of the right one. 1033, I'm pretty sure, is with regard to eminent domain. That's not an exchange we deal with frequently. Once every 2 or 3 years, we'll get a phone call about that. So that's if a client owns a piece of property and one day the state government comes and says, hey, we're gonna build a highway we need to tear down your house and build a highway. The client has to sell to them. And they're able to do a 1033 exchange to avoid any of the capital gains taxes that they would otherwise incur on the sale, because the government does pay them fair market value of the property at that time. I believe the way that works is you have like a 2-year period to reinvest the funds. And to be honest, I don't know if they have to like use an accommodator like us to do that. A lot of times I have had clients in the past who have they have the option to do either 1033 or 1031, and they have chosen 1031 just because I'm trying to remember there was some reason or benefit tax wise for them setting up the exchange and trying to do it that way. Oh, I think it's because 1033 does require you to buy, like, if you sell a single family house, you have to buy a single family house. If they tore down your commercial building, you have to buy a commercial building. Whereas 1031, it's just investment for investment. So it gives you a little more flexibility as to what you want to do. That's my understanding. But again, I don't deal with 1033 super frequently.
Okay, so the next one, before we get to the raise hands, just in order, do flip properties, qualify?
That's a great question. And the answer is it depends. When I do webinars, just to avoid confusion, I try to go with the most clean cut answer, whatever that would be. And so the best answer I could give to that question, do flipped homes qualify, would be no. The reason for that is that the IRS makes a distinction between investment use of a property and speculation, use of a property and personal use of a property. The only ones that qualify for 1031 are those that have been used for investment. So if you have a property that's been rented out for a year or 10 years, whatever, you're going to qualify for 1031, no problem. That's very clear investment use. But if you have a property that you bought 6 months ago and if fixed up and are ready to flip now, at that point, it gets into speculation territory with regards to the IRS's interpretation of what's going on. I think it's investment. I don't really know why they make that distinction. And from time to time, we do have clients who do try to exchange those kinds of properties anyway. It's just, we always have to make them aware of what the risks are in doing that. Where it really becomes a no-go is if you have clients who are like flippers by trade. Like if you have clients who are flipping 10 properties a year, at that point, they definitely cannot exchange at least the vast majority of the properties they're flipping, because at that point they are considered dealers. And then it's like stock in trade, and they're doing it much more on a speculative basis per the IRS. Than rental properties would be, or that if one client did one flip in their whole lifetime, maybe they could try. But again, the general answer to that question is no, flips do not qualify for 1031.
Okay, next thing is, how do you calculate profit for 1031 exchange? Let's say the example here, sold price minus the original purchase price. What if the property still carries a big mortgage and there is not much left after paying off the fees, commission, and mortgage?
Yeah, I do have another, maybe I can try to pull it up on the screen. I have another slide deck that does go through tax basis and profit and like how those things stack up. But this is a typical point of confusion. So the simplest answer to your question is the profit is the difference between what the client purchased the property for, the price, and what the price that they could sell it for today. There are a couple other things, like whether they've claimed depreciation over the last couple of years that can affect that amount of profit. But again, without getting too complicated, the general answer is, you bought for $500,000, you're selling for $900,000, you have $400,000 in taxable profit. The mortgage balance, on your question about that and paying off a mortgage has nothing to do with profit. They don't care how big of a mortgage balance you got when you originally purchased the property. It doesn't matter if you refinanced during your time of ownership. It does not affect profit. Really, profit is just the difference between purchase price and sales price.
Okay, and then I was going to get to Kevin Laurent. You're still on because your hand was raised. Just went down.
Greg, hey Greg, yeah, no, just pass me. My question was answered.
Okay, great. Okay, Rob Dorton and Jack, there's there.
Sorry, I'm stole Rob's computer. Hey, so my question is, I'm just trying to get clarification on re-identification of property. Is that an absolute that you cannot re-identify past those 45 days?
It is, yes, and that is not to say that we, don't have clients that try to break that rule aggressively. Yeah, if you were to be audited and the IRS sees that you bought something that was not identified on that form within the 45 days, they're going to invalidate the exchange, no questions asked, and make you pay the taxes.
Okay. Yeah, I didn't know that. I thought you could actually change it.
Yeah, well, up until the 45th day, you change your mind as much as you want.
Right.
You don't actually submit that finalized list to us until day 45. But yeah, once that 45th day passes, there's no change in your mind after that.
Okay, cool. Thank you very much.
Yeah, no
Great.
problem.
So the next question is, are we taking original purchase price, question mark, versus if someone was to refi, question mark?
Well, yes. So again, the refinancing and stuff, that's just putting debt on a property. That does not affect profit at all. So you are correct. Yes, it's the difference between original purchase price and the price that they could sell it for today. I think also in the previous question on this, I did miss one portion of it. You asked about brokerage commissions and title and escrow costs, how that affects profit. You are allowed to back that out of whatever the sales price today is. So as an example, if a client bought for $400,000 originally, that was the price of the property. And then now they could sell it for $1 million. You are allowed to back out brokerage commissions, title and escrow costs when calculating profit. So really, rather than it being $1 million sales price that you're going from, it's like $950 or whatever. And the difference between that 400 original price and the 950, the net sales price, that's going to be your profit.
Also, Justin, is there any way, one of the participants here said that like the slide deck as far as the tax basis to calculate, thank you, or do you have an example that you can provide me and Lynn so that we can give to them?
With regards to like calculating tax basis?
Exactly, yeah.
Yeah. I have slides that I can send you guys, that go through that. I'll try to make sure before I send them to you that they don't need me as a presenter for them to make sense, but I do have some stuff that shows you the difference between the two.
Yeah, if you can just Lynn and CC me too as well. All right, thank you. The rule for reinvestment is based on the equity amount has to be greater than the original one. I heard about the same for loan amount. Is that true?
So super common misconception with the exchange is the need to replace the debt. The two main requirements of the exchange, the first one you had right there, reinvest all the equity that's coming out of the sale. The second requirement is that you buy property of same or greater value relative to the sales price of the property that you sold. So you sell for $1 million, you need to purchase new property for at least $1 million. Now, let's say after paying off your loan on your $1 million sale, you had $600,000 in cash equity available to you. So you'd put the $600,000 down on the new $1 million purchase. Whether or not you make up that $400,000 difference there between the equity and the purchase price with a new loan or with cash, the IRS does not care. So people, I think, typically say that you need to have the same loan amount. Really what they mean by that is that, if you reinvest all the cash and you have the same loan amount as you had on your sale, inherently, you're going to be buying property of same or greater value, which is the actual requirement. But I don't think I think it's a confusing, we have clients sometimes, actually a lot of the time, who don't want to take out new debt on the property that they're buying if they don't have to. So I do like to make the distinction when I can. Yeah, it's just reinvest the cash equity and then buy new property of same or greater value. The IRS does not care how you make up the difference between those two numbers with either a new loan or cash from your checking account. I don't care what they say on the internet. I'm right on that one.
Okay. So next, before we get, there's a couple other questions too as well. But now, one of the questions was, is do you have to purchase exactly, say you sell for 450, do you have to purchase 450, or is there a percentage rule that you can go a little bit less without being taxed?
Yeah. So all the examples I gave, I always try to give it from the perspective of this client pay zero taxes whatsoever. To your question though, yes, if they sold for 450 and let's say they bought a new property for 350, they're just going to be taxed on that $100,000 difference. So they're going to pay like basically pro rata share of their capital gains taxes on that amount that they bought down by. So the exchange can still be a big benefit to them, even if they're most of the time, even if they're buying a little less than what they sold. But in order to get the full benefit of the tax break, they have to be buying for at least 450.
Okay, now the other question is then work live. We talked about the work live. There's a percentage of space for work, related, and then they're going to purchase another property like that. Is there have to be like equal to or more than the workspace they had before? How does that work to say that, that this, qualifies this? This is an equal type of exchange.
Yeah, so typically this goes off of the square footage of the workspace. It's a really interesting use of 1031 too. I think after COVID, or really during COVID, like everyone had a home office, right? So whether or not you were documenting that on your tax return, it's certainly better if you were as to whether or not you want to qualify or you're going to qualify for the tax break. You don't have to list it there, but it just helps if you do. But everyone had a home office, right? So these are coming into play a lot more than they used to. The way it's calculated though is square footage of the actual workspace relative to the square footage of the total property. So as a simple example, if you have $1 million sale and 10% of the square footage of that property was this home office portion, you effectively then are selling $100,000 of investment property. And so you then, with regards to the exchange requirements, just need to go and purchase new property worth at least $100,000 to get the full benefit of the exchange. Greg, I think in your example, you were asking like, if the client is looking to go into another primary residence of theirs, like if they're selling one that had this workspace and they're looking to put the money into a new primary residence that has a workspace, it really just goes off of whatever that dollar value equates to. So in my example, 10% of $1 million property is $100,000. They would need to make sure that whatever the square footage of the new property was, relative to their the square footage of the workspace, I should say, in the new property relative to the overall square footage would constitute at least $100,000 of property value. But again, they could also exchange out and get into like a single family home or like a rental home or a rental condo or something like that too, as long as
Okay. Outstanding. And then Kevin, you have your hand raised. Was your question answered?
I guess, I do have a couple questions, but for the sake of time, I don't think we'll probably get into them. But I don't know if it's easy to explain, but Justin, could you go into like reverse 1031s and DSTs?
Yeah, 100%. I can speak to that. Good to hear from you, Kevin. I have worked with Kevin many times. So the reverse exchange is basically exactly what it sounds like. It's a normal 1031 exchange, everything I've described here, except the entire timeline basically happens in reverse. So rather than a client selling their property first and then buying the new property second, a reverse exchange is where the client purchases the new property first. And then within the 180 days following the purchase, they just have to close on the sale of their property. Someone else asked about price earlier. The prices for these two different exchanges are quite different. A standard exchange where they're selling first and buying second, way more simple to set up. Those are like about $1,200. A reverse exchange is about $6,000. The reason for the difference in cost is that we as the accommodator are required to take title to either the one they're buying or the one they're selling. And so it's a lot more paperwork and liability for us. But yeah, that's the general difference. All the same actual reinvestment requirements still apply. At the end of the day, you still have to put the same amount of cash equity into the new property you're buying. If the new property has to still be of same or greater value to the one that you sold. Really, the only thing that's reversing is the timeline. You're buying the new property first, you're selling the existing property second. And honestly, it's when I have a client who has the funds available to, to be able to put down on a new property and buy first, it is really the preferred way to do 1031. Anytime I have a client that can do it that way, I'm trying to suggest to them that they should do it that way, regardless of the slight difference in price. You pay $4,000 more or whatever for a standard exchange or for the reverse exchange. It's really nothing relative to the security that you get that you're not going to lose $100,000, $200,000, $300,000 in taxes. The reason I say it's easier is because the standard exchange, you have that 45-day timeline. That's a really stressful time for a client. You're kind of staring down the barrel of your tax bill for a month and a half. And if you don't find anything to buy, you're out of luck at that point, and you're going to be stuck paying the tax because you do trigger it the second that you sell your property. The reverse alleviates all of that. You buy the new, you take as long as you want to shop rather than, being forced to shop at a rush. Take as long as you want to shop for this new property. Make sure you find something you really like. Make sure you're actually able to close on it. And then within the 180 days after closing on it, you just have to sell your property, which in this market is like no problem at all.
Okay, so
Yeah,
Justin, the
And
question
that's
real
why I
quick.
brought that up, because in this market, it could be very difficult to select 3 properties and have them even get offers accepted. So the reverse is the best way to go.
Totally. Yeah.
So the question to that everyone would want to know though, is it have to be their own cash or they can use financing for that?
You can use financing. So at the end of the day, again, all the same reinvestment requirements apply. So as an example, you sell it, if you have $1 million property to sell and you have 600,000 in cash, again, whether it's a standard exchange or a reverse exchange, you need to have that 600,000 reinvested at the end of the day. And the new property that you bought has to be worth at least $1 million or higher. So as an example, let's say if you're buying first, let's say you put $200,000 down and you finance the rest of your purchase. That's totally fine way to begin the reverse exchange. We also, as a quick aside to that, lenders a lot of times get pretty funky with regards to reverse exchanges, just because, again, we have to take title to either the property their client's buying or the one they're selling. Lenders get all freaked out. We do have a lending department in-house that actually owns specifically for reverse exchanges. And that's the whole reason, is because we have lender kind of partners and a lending team here that's able to explain it to lenders in such a way that they're still willing to do the deal. But great thing to be aware of if you're dealing with any clients doing a reverse exchange. But Greg, back to your question, if you put $200,000 down and you buy the new property for $1 million, then within the following 6 months, your 180 days, your sale property sells for $1 million, and that 600,000 in cash becomes available from your sale. We would, again, we have to make sure that that's in total, you have 600 in cash reinvested. You had already put $200,000 down. So what we would do is take $400,000 of those sale proceeds and pay down the loan on the property that you bought. That remaining 200,000 from your sale then would go back to you, and it's effectively like a reimbursement for the cash that you had originally put down.
Great. And Kevin, you had a second thing you wanted to ask, Kevin?
Yeah, DSTs, Justin, do you guys do those?
Oh, yeah. Sorry, I forgot that portion of your question, Kevin. Yeah. So DSTs, we do not sell them directly. DSTs, what Kevin is referring to, are one type, and really the primary type of those totally passive investments that are available to clients. It's the ones that earlier in the presentation I was saying are structured very much like a REIT. You have like a professional real estate company that owns all these different properties. And as an investor, you can buy shares in an individual property or a portfolio of properties that the sponsor, big real estate company put together for you. Again, they're structured a lot like a REIT, but they are not the same as a REIT. If you buy shares in a REIT, you're buying shares in a business. That does not qualify for 1031 reinvestment. DSTs do qualify because you are actually taking a deed interest in the real estate that underlies that fund-like structure. That's what allows them to qualify for 1031. So you know, we have clients who get into those all the time when they're tired of, Kevin, you recently dealt with a client yourself, I'm forgetting her name now, who was selling a property, I think, if I'm remembering correctly, but was tired of dealing with management. She's in her 50s, 60s, been dealing with this, kind of headaches around management for a long time. The property went up a lot in value, and she was just looking to take all that profit that she had and all the cash in the property and put it into an investment vehicle that does not require her like day-to-day involvement. That's exactly what a DST offers. Literally, they just send you a check in the mail every month. You are literally not responsible for like any sort of management on the property whatsoever.
Okay, outstanding. Is it Shuang? Did you have it one too? I know that your hand.
Yes, I have a basically a very quick question. So back to the original question that if you like last 5 years, if you like live there for 2 out of 5, you can get the benefits. But I have a question. So what if you buy some property to begin with as a primary, and then you move it out and rent it for like 10 years, and then last 2 years you move back. So now you probably own like a totally 12 years, but then you leave 2 out of the last 5 years. But can we still like get a $500 exemption, a $500,000 exemption tax?
Exactly. Only thing you're looking at when you're figuring that out, the primary residence tax exclusion, is those last 5 years prior to the sale of the property. They don't care how you divvied it up. You can have moved out, lived in it before, rented it in the middle, whatever. If you have used it as your primary residence for 2 of the last 5 years, you qualify for Section 121.
Okay, terrific. And second question, like regarding the reverse exchange, what if say, I'm like doing buy first and then I'm going to sell, and then all of a sudden the market crash, and then so my property right now is like say $1 million, and then I was going to buy and exchange into $1.2 million. All of a sudden the next property I got has become a $900,000. By the time by the 180 days mark, I sold my primary. Now I'm lower than my current. So wait a minute, it's not going to happen. Never mind. I already got it myself. Thank you.
Yeah. But you're right. I mean, and that's totally like a risk that you would run if you're doing a reverse. Both the standard and reverse exchanges have the risk. I guess that's the main kind of risk for a reverse exchange, is that the market would crash and you'd be able to.
Right. The market, but the things I realized, if the market crash, they crash on both properties. So I should be still okay.
Yeah, well, yeah, exactly. And if you do it in the standard exchange, you've got the whole 45-day risk. So it's just a matter of which one you're more scared about. For me, the way I think of it is like, if you sell your property when it's gone up a ton in value, you've triggered the high tax bill. There's no way around it. Like you've triggered the tax bill, you've triggered the timeline, and you're forced to shop, pretty quickly there. So it's more of like a for sure risk that you're going to have. Whereas what you described in the reverse exchange example is a little bit less certain than the standard exchange kind of risk.
Yeah, but on the other hand, for the reverse one, and then the homeowner has to have the ample either cash or able to get a loan to cover it because you haven't sold your property yet, right? So you cannot use that equity yet.
Right, exactly. Yeah, and if you don't sell within the 6 months, then you don't get the tax break on the sale, and you still have to make sure in the event of a reverse that you sell your sale property within the 180 days following the purchase, so that you can, like you said, pay down a loan if you use one to buy the new property first, and just to get the full benefit of the tax break.
Well, thank you so much.
Sure, yeah, for sure.
Okay, so the next question too is in Kai, maybe you want to ask this question yourself, but it has to do with a lot of these programs that are out there that charge, and maybe because you're not competing within the real estate market if you don't have some cash to buy a particular property. So you have another company come in, they will then purchase the property for you, title, then charge you on the back end because you're selling your property. Is that going to complicate things? But Kai, do you want to explain a little bit more what you're asking?
Yeah, so I was just wondering, like, if someone wants to use the First Team Forward program, like use the equity that they have in their home right now to buy another home before they sell, could they still take advantage of the 1031?
Yes, yeah, we have clients that use, it sounds like some sort of a bridge loan that you guys are offering. Yes, and we have clients that do that fairly frequently. Yeah, that'd be fine.
Okay, Great. And then the last one here that we have on here, someone wants to be able to walk through, and I think it would be good for everyone, but can you walk through the how-to on the co-branding website, please?
Yeah, for sure. I think you can still see my screen here. Let me go to so this is the actual web page. It adjusts to this like funky kind of thing after you type it in. But as an example, like if you go to First Team, so selltaxfree.com/first team agent, it just redirects. So we have like a tracking code here, but this is the thing that it actually brings you to. So you can schedule consultations with us here. It's like kind of a subset of our main website. But as an example, here are those two tools that we had talked about on the call. Co-branded landing pages, if you want to build one, you're just on the home page, you just scroll right down. This is the spot to do so. All you have to do is enter this basic information on yourself: first name, last name, email, phone, and then license number. You can pick the first team scheme. We've done these with a couple other real estate brokerages, but you guys just would pick first team. And then there are these two different versions you can choose from, and you can preview those here. I don't really remember what the difference, it's just like a difference in layout. And then give us your description and your picture. And that's basically it. You click submit, and I haven't done this in a long time, but I believe the link is just emailed to you right after that.
Outstanding.
Yeah.
Okay, all right. Is there any last minute question for Justin before we wrap this up?
Yeah, well, it was awesome talking with everyone. I've really enjoyed working with all of you over the years. I've done a lot of work with First Team agents, so I think you guys are great, and thank you all for your time and attention. I'll put my contact information back up on the screen here. This is me. Feel free to send me an email if you need. Oh, I shouldn't click. Sorry, I'm in present mode. But this is my email. This is the phone number to reach us. It's the office line. We're here 8:30 to 4:30 Monday through Friday. This is exactly what we do. Is consult with agents for deals that they're and consult directly with their clients. So yeah, thank you all for your time. Thanks for having me.
Yeah, Justin, we really appreciate you. Thank you so much. It's a very informative, Zoom training today. However, we do appreciate that. Also, whatever you can get myself and Lynn to help us walk through all the information we shared today would be great, because we will post this on our intranet site on First Place on Together We Are First Team later today or tomorrow. Also, everyone, just reminder, I believe it's May 12th, we have Jason Pantana from the Tom Ferry training that is going to dive deep in, more about relationship building and more into the social media, etc. That's going to be on May 12th. That is a registered webinar that First Team is putting in for the entire organization. And then we also have next week, we do have for May, you will receive the May trainings coming up. They'll be out within the next day or two for all the trainings, but we do have risk management with Hila Pooley going to be coming up, and how to stay out of legal trouble, and also legal updates too. So anyways, we appreciate all of you. Thank you for being part of First Team, and we'll see you next week. All right. Bye-bye, everybody.